We've discussed in length about building blocks of investing in fixed income. Now, what are the tools and so on? But today we will see what are mistakes that one should avoid while investing in debt funds. And joining me on this is Santosh Navlani, COO of ET Money. Santosh, good evening. Welcome to the show. We are going to talk about investment in debt funds, or more specific, common mistakes that investors do when they choose or when they invest in a fixed income product or a debt instrument. But let's start with your experience on ET Money. What kind of questions or what kind of doubts do people have when they want to invest in a fixed income instrument?
Hey Kavita, hi. With respect to ET Money, we've always get investors asking us all sort of questions, Kavita. Unfortunately, what has happened over last decade or more, a lot of investors have been exposed to equity mutual funds in a very broad way and have learned a difference between active funds and passive funds, or what are the different kind of market cap equity funds, like large cap, mid cap, small cap. But that kind of knowledge is not really reflecting in the investors' understanding with respect to debt funds. I think the bigger thing that we get to know from people is what kind of debt funds they should be investing in first place, if and when they look to invest in debt funds beyond returns. So we do kind of get queries on kind of debt funds they should be considering, because there are more than 16 categories of debt funds in the market. And of course, it's about taxation, what kind of returns people should be expecting, and should they be investing in a specific debt fund based on some recommendation they received in the past or not. So the queries are never different in terms of what they kind of get for equity funds. I think most people with respect to investments always have this question about, should I be investing and what kind of returns I should be expecting.
But when you talk about debt funds, when you talk about fixed income instruments as an entire category also, people often think that it is risk-free and your money will be safe. Is this a kind of a mistake that one does when they want to invest in a debt product? The kind of positioning or the labeling these products have, although it is made clear a lot of times by SEBI also that there is a particular amount of risk that also involved, which an investor should know. But what is the kind of common mistake that investors do?
Yeah, so I don't think people do think that the debt funds are risk free. I think the moment you talk about mutual funds to retail investors in the country today, most people actually kind of remember the disclaimer of mutual fund, which is mutual funds as investments are subject to market risk. So they actually believe that any kind of fund actually has risk inside it. But the mistakes that people actually make are no different what mistakes they make in any kind of investment product for that matter, or mutual funds in with respect to equity in that sense. Unfortunately, as layman investors, we only have one parameter of judgment or measurement with respect to investments potential for our suitability, and that is returns. So only thing which is always visible for any kind of asset class is returns only, which is basically past returns or recent year returns. So I think this golden mistake, if I can use that word, applies to all sort of investment decisions people make. They actually make a mistake of looking at past returns, and one should actually always be worried about investing based on past returns, because the more the past returns have been, the higher the chance that you would not possibly be getting that kind of return for your next immediate future. And it applies to equity, debt, gold, all sort of investment decisions.
About the returns that you explained, that one should really not chase returns when you're selecting a debt fund or investing in a debt instrument. But what about the risk? Are they risk free? What kind of risk is associated when you invest in a debt fund, and how people usually forget or ignore this aspect?
Yeah, so the kind of risks which are associated in debt funds actually is quite different from the returns risk that we see in equity funds or different kind of other asset classes. If you focus on debt funds, the risks are actually of primarily, I would say, two types. One is the credit risk, and second is the interest rate risk. What does credit risk mean? In layman terms, if I can put it, like all of as individual borrowers in the banking sector, when we approach a bank to take a car loan or a home loan or a personal loan, most often the banks will actually first refer our credit score, as it's called in banking parlance, CIBIL score or a experience score or CRF score. Different banks will use different kind of credit agency kind of scores, and ultimately what they get to know is what is the probability of defaulting on the interest rate payments or the principal payments, that when it comes to our repayment track record. Similarly, there are credit rating of companies, which is akin to like a CIBIL score or experience score of individuals. So there are ratings available for different companies: AAA, Sovereign, AA, B minus, and things like that. So the better the rating of the company, the higher the probability that the company will pay back the principal and the interest rate if and when it is due. So if the fund manager is putting money in a company where the credit rating of the company actually undergoes a change and becomes good to worse, that's a risk that you would kind of undertake as an investor when you invest in debt funds. And second kind of risk is interest rate risk. Now, typically when we put money in fixed deposits, we know that the bank assures us that I will get 6%, 6.5 or 7% return, and that will not change during the tenure of the FD. But what happens in debt funds is, because most debt funds actually invest in debt securities, which is listed on the debt market, they undergo trading of securities on daily basis, and hence the price keeps changing. So what happens is, in a rising interest rate environment, the bond prices actually tend to see a kind of a downward pressure on the prices, and in a falling interest rate environment, typically the bonds prices actually appreciate. So when you invest, you would not know as an investor whether the interest rates are going to rise in the future or going to fall in the future necessarily, and hence you'll be exposed to these kind of uncertainty where your debt fund might see increase in returns suddenly or see decrease in returns because of interest rates rising. So those are the primary two risks that you'll be exposed to. And of course, there is fund manager underperformance risk that you'll be exposed to. There can be other unknown risk in terms of liquidity risk itself, where nothing has gone wrong with the papers of the debtor when you've invested in money in. But for some reason, nobody's interested in trading securities of that paper, and hence the price will be having a pressure.
Scenario, Santosh, do people usually miss out on tying up a goal to their debt investment? Is that a mistake?
Yeah, so typically, since there are 16 categories of debt mutual funds, Kavita, it's very legible to kind of, believe that there'll be different debt funds made for different kind of investment horizons and goals. I was listening to the guest speaker before this, and I think somewhere he mentioned that he believes putting money in 2 to 5 year maturities is a good healthy practice that he follows, and I would actually second that. Typically what happens is, you should be always taking lesser interest rate risk in the portfolio, and preferably no credit risk in the portfolio, because ultimately when you're putting money in debt, you are either replacing your fixed deposits or buying debt funds as a part of your asset allocation plan, or third, maybe you're basically saving for a short term goal or emergency fund. In all the three scenarios, you actually are investing for shorter tenure investments. And when you're doing that, it's always better not to take interest rate risk. That means limit yourself to short term debt funds, corporate bond funds, or money market funds, or ultra short term category. These categories will typically not undertake interest rate risk in the portfolios, and you would see possibly more of a stable investing experience when you're investing in these funds. So of course, you should be looking at the tenure of your investments and try to match or buy a lower dated debt mutual fund paper in terms of interest rate risk, rather than actually trying to match it exactly or taking more long-term dated paper for a short-term investment duration.
When you're choosing a debt fund, should one really consider their tax slabs also? Is that a common mistake which people really miss out on?
Yes, Kavita. So I actually, I don't think as retail investors, we've been exposed to a lot of debt investments in our portfolios. In fact, hardly 1 in 5 mutual fund investors in the country would actually be investing in debt funds, as per our records. Now, given this is kind of such a new behavior people are exhibiting, which is good to invest in debt funds. I don't think a lot of people have made mistakes of actually overlooking their tax slabs for investing in debt funds before investing in debt funds. But nevertheless, it's a good thing to keep in mind that you, as an investor who is actually earning income which actually is getting taxed at only 10% income tax slab, you may not be actually benefiting a lot from debt funds. Typically, debt funds are a good replacement for fixed deposits and are more tax efficient. So, if you are somebody who's actually 10% tax bracket, you would notice that the difference in returns of FDs and debt funds may not be much. If at all there is difference, it is not much. So, a 10% tax bracket, even if it is efficient, kind of product on taxation side, you will not get advantage. So typically people who are upwards of 20% tax slab or 30% for sure should be looking at debt funds as a primary way of kind of fixed income part of their portfolio over fixed deposits. I would not really say this is a mistake, but if you look at it, your tax slab before investing in debt funds, you might be making better return post tax.
Santosh, what happens is, although there are 16 categories in the entire debt fund category, if I talk about, there are 16 type of funds in which you can invest. A lot of times people don't know exactly what is the kind of investment portfolio that a debt fund has. How important it is for an investor to know where the debt fund is investing, the quality of exposure and the kind of portfolio that is maintained. Do people really miss that out, which can be called a mistake?
Yeah, I think Kavita, that mistake possibly is applicable to a lot of investments in the country. People don't really take their time out to understand what is the fund actually doing. Many times, people may not even understand that they've picked up a fund based on past returns, and it turns out to be a small cap fund or a mid cap fund, and not necessarily diversified equity fund. So I would say that mistakes does happen, and in debt funds, it's actually kind of not very difficult to solve that for yourself. Always understand that you should be investing towards a shorter end of the yield curve, which means you should actually be not putting money in funds which buy long-term dated papers. By definition, when you are investing long-term dated papers, you are actually taking interest rate risk in the portfolio, because over a long period of time, like 5 to 7 years, interest rate cycles does change, and hence you will unknowingly taking interest rate risk in the portfolio. And of course, if you as a fund manager are lending money to a company for long periods of time, the company's business model might undergo change, and hence you'll be exposing yourself to credit risk as well. So in both the scenarios, always better to actually invest in funds which limit themselves to 2 to 5 year, 2 to 4 year maturities, and short-term debt fund, corporate bond fund, banking and PSU, money market, ultra short term, low duration. These are the 5 7 categories which actually can do all the job that debt funds can do for your portfolio. And it may not even make sense to look at other exotic categories like credit risk, long duration bond funds, dynamic bond funds. You would possibly be inviting more volatility in the risk returns for your portfolio, and returns may not even come, if at all they come, from those investments.
Expense ratio. What kind of expense ratio would a debt fund have?
So in market, you would actually come across funds which will have expense ratio from kind of as low as 5 basis points to as high as upwards of a percentage. One thing which is always important to know in investments is the lower the expense ratio, the better it may be for you as an investor, and applies to equity, applies to all the more to debt, simply because of one reason, Kavita. So in debt funds, typically your returns will be about 50 60 basis points to 1 to 1.5% extra over inflation. Chances are very high your returns are going to be in the region of 6 to 8% annually. And if you actually are investing in a fund where expense ratio is upwards of a percentage or even towards a percentage, that means you are shaving off almost 10% plus return from the portfolio that you would be getting returns on. So always better to limit yourself in funds where the expense ratio is actually in the realms of a few tens of basis points, like 10 to 30. And that's where you will possibly making some kind of alpha over fixed deposits and post-tax returns. Otherwise, the expense may not be keeping pace with the returns that the fund may be generating over fixed deposits. So always prefer a fund where the expense ratio is actually geared towards few tens of basis points and actually towards a percentage point.
Santosh, a lot of time what happens is when people invest in a debt fund, like equity, they try to time the fund, their entry in the fund, the exit in the fund. How and why should one avoid doing this?
So, Kavita, one of the primary things with respect to timing of debt category, which can go wrong, is you may not be able to get the interest rate cycle right while investing. So, what happens is, the interest rates in the economy keep changing based on the inflation, based on the macroeconomic factors, because of global economy. So like today, like yesterday, when CPI numbers came in and the CPI came at 7%, a lot of people would possibly be kind of a bit surprised, because for last 2 months the CPI was actually trending towards 6.5, 6.4, and people may have expected the inflation is under control and it might go down. Now, the moment you look at 7% CPI, that means RBI may not be actually comfortable with a benign investment interest rate environment and may actually increase the interest rate itself. Now, the moment that happens, that means your portfolio on debt side will go wrong in terms of returns. So, what you need to do is you cannot kind of time your investments knowing that what interest rates are going to be happening in the economy over next 6 to 9 months. So stay away from timing. The way we have learned in equities that you can't time the market. Similarly, you can't time the investments in debt markets as well, because interest rate risk can come from nowhere in your portfolio and may surprise you. And always remember, the volatility in debt will be more risky or more detrimental to your portfolio than equities, simply because the interest earning or return earning capacity of debt funds is in single kind of percentage points over fixed deposits, and not like a multiple of it like an equity. So why take risk with respect to timing it? And always follow the same systematic principles. Invest over a period of time. Don't try to time the kind of category based on the past returns. Always look at what your goal is, what your horizon is, and find the ideal category for that.
All right, and always align your investment portfolio, and especially equity or debt, whatever kind of investment instrument you're choosing, it should be lined up with your financial goal. Thank you so much.